Welcome to the CPA Quick Review on Financial Ratios. This recording is designed as a final refresher before your exam. As you listen, focus on what each ratio measures, whether a higher or lower result is generally better, and how changes in the numerator or denominator affect the calculation. Remember, the exam often tests your understanding of the concept behind the ratio more than memorizing formulas. Let's begin with liquidity ratios. The current ratio equals current assets divided by current liabilities. It measures a company's ability to pay its short-term obligations using short-term assets. A higher ratio generally indicates stronger liquidity. If current assets increase, the ratio increases. If current liabilities increase, the ratio decreases. A ratio above 1 generally means current assets exceed current liabilities. The quick ratio equals quick assets divided by current liabilities. Quick assets generally include cash, cash equivalents, marketable securities, and net accounts receivable. Inventory and prepaid expenses are excluded because they are less liquid. This ratio asks whether the company could pay its short-term obligations without selling inventory. Working capital equals current assets minus current liabilities. Unlike the previous ratios, this one uses subtraction instead of division. Positive working capital generally indicates a stronger short-term financial position. Now let's discuss efficiency ratios. Inventory turnover equals cost of goods sold divided by average inventory. It measures how quickly inventory is sold. A higher turnover generally indicates inventory is moving efficiently, while a lower turnover may suggest slow sales or obsolete inventory. Receivables. Turnover equals net credit sales divided by average net accounts receivable. It measures how quickly customers pay their balances. Asset turnover equals net sales divided by average total assets. This ratio measures how efficiently assets generate revenue. A higher ratio generally indicates better use of company assets. Return on assets, or ROA, equals net income divided by average total assets. While asset turnover measures revenue generation, return on assets measures profit generation. A higher return on assets indicates the company is generating more profit from its assets. Next are leverage ratios. The debt-to-equity ratio equals total liabilities divided by total equity. It measures how much debt financing is used compared to owner financing. A higher ratio generally indicates greater financial leverage. Times interest earned equals earnings before interest and taxes, or EBIT, divided by interest expense. This ratio measures a company's ability to cover interest payments. A higher ratio indicates a stronger ability to service debt. Now, for profitability ratios. Gross profit margin equals gross profit divided by net sales. Gross profit is simply sales minus cost of goods sold. This ratio measures the percentage of revenue remaining after inventory costs. Profit margin equals net income divided by net sales. It measures overall profitability after all expenses have been considered. A higher profit margin means the company keeps more profit from every dollar of sales. The dividend payout ratio equals dividends divided by net income. It measures the percentage of earnings distributed to shareholders rather than retained within the business. Basic earnings. Per share, or EPS, equals net income minus preferred dividends divided by the weighted average common shares outstanding. Remember to use weighted average shares, not ending shares. Also remember that stock dividends and stock splits are applied retrospectively when calculating weighted average shares. The price to earnings ratio equals market price per share divided by earnings per share. It measures how much investors are willing to pay for $1 of earnings. Companies with higher growth expectations often have higher price-to-earning ratios. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Although it is not a generally accepted accounting principle measure, it is commonly used to evaluate operating performance before financing decisions and non-cash expenses. There are two common ways to calculate EBITDA. Using the top-down approach, start with revenue and subtract cost of goods and all operating expenses except interest, taxes, depreciation, and amortization. Using the bottom-up approach, start with net income and add back interest expense, income tax expense, depreciation, and amortization. Return on equity, or ROE, equals net income divided by average equity. It measures profitability from the shareholder's perspective and indicates how effectively management is using owner's investment to generate earnings. The equity multiplier equals average total assets divided by average equity. It measures financial leverage. A higher equity multiplier generally indicates greater reliance on debt financing. One of the most tested concepts is the DuPont return on assets analysis. Return on assets equals profit margin multiplied by asset turnover. In other words, net income divided by net sales multiplied by net sales divided by average total assets. This analysis shows that a company can improve return on assets in two ways: by increasing profitability through a higher profit margin, or by using its assets more efficiently through a higher asset turnover. Before we finish, here are a few high-yield exam tips. First, identify whether the ratio measures liquidity, efficiency, profitability, or leverage before trying to calculate it. Second, if the numerator increases while the denominator stays the same, the ratio increases. If the denominator increases while the numerator stays the same, the ratio decreases. Third, when average balances are available, such as average inventory, average assets, average receivables, or average equity, those averages are generally preferred over ending balances. Let's finish with a rapid-fire review. Inventory turnover measures how quickly inventory sells. Receivables. Turnover measures how quickly customers pay. Asset turnover measures how efficiently assets generate sales. Return on assets measures profit generated from assets. Debt to equity measures financial leverage. Times interest earned measures the ability to pay interest. Gross profit margin measures profitability after inventory costs. Profit margin measures overall profitability. Dividend payout ratio measures earnings distributed to shareholders. Basic earnings. Per share measures earnings available to each common share. Price to earnings measures investor expectations. EBITDA measures operating performance before financing and non-cash expenses. Return on equity measures profitability from the shareholder's perspective. Equity multiplier measures financial leverage. Finally, DuPont return on assets explains that return on assets equals profit margin multiplied by asset turnover, combining profitability and efficiency into one measure. That concludes this CPA quick review. Understanding what each ratio measures is far more valuable than memorizing formulas alone. Stay calm, trust your preparation, read each question carefully, and let the concepts guide your answers. Good luck on your exam, and thank you for listening.